All right, guys, a new video idea today for the Everything Money Plus channel. We're always trying new ideas. Today, we're going to go through something very interesting. Tim and I were on a call today, and he said, Paul, did you see all the great companies that are at 52-week or near 52-week lows? And I said, I have not. And he said, Paul, check out our software. So I pulled it up. We have two options here. One is stocks at 52-week lows, and one's near. Guys, there's some big names out here. So what I want to do is teach why I look at those, and then we're going to pull some of them up and look at their potential value. Michael Burry entered a position in one of them through some calls, so we'll go through that as well. So first off, why do I like 52-week lows? Guys, remember, if you're new to the channel, you're going to have to hear this. A stock being down does not make it a deal. It makes it cheaper, but not necessarily cheap. That's a very important thing I want you to remember. It's not that they're lower and that makes them cheap. It's about saying, if they're at a 52-week low, what is the market saying? They're saying it's out of favor. Maybe some news came out, but it's a great place to look for value. Again, doesn't mean it's cheap. It just means it's cheaper. And guys, look at these names out here on this board. Let me get myself some writing ability, but look at this. We've got Microsoft. Microsoft is the first one on here. It's actually up 5% today. 5%, up $18. But before then, it was down quite a bit. Meta's up, but it's there. Netflix, Palantir, Alibaba, McDonald's. I'm just looking at the ones that are big for us. Salesforce. We have SAP, Intuit, Adobe, O'Reilly Auto Parts. I mean, guys, AutoZone, Nike, huge companies at big time lows. So remember, if you're an investor, what does this mean? When you're an investor, what that means is you can buy companies cheaper that you can then let compound for a long time. You know, we're in the world of immediate gratification. What can I get right now? And I get that. And a lot of people want to know, what can I buy today? And that is a wonderful way to look. But if you don't know why you're buying something today, in all likelihood, it will fall further. And if you don't know why you're buying, you're going to get scared and you're going to sell. And that's why we're here to teach a process. A company's fundamentals can keep getting better while the stock price falls. That's the best of all worlds. And I want to go through a couple of companies today, one of which fits that exact criteria. But let's go through Microsoft today, because like I said, Burry has a little position on Microsoft. What Burry has done is he's bought calls for the future. He thinks Microsoft's going to absolutely skyrocket. It is at $371 per share. The all-time high is also the 52-week high of 555 that was less than 1 year ago now, about a little under 11 months ago, from 555, and yesterday hit 350. That is a 40%, almost a 40% drop in 1 year. Now, if you just looked at the price and said, okay, the stock is down 40%, and all you believed was a stock that's down 40% means that it's a worse company, then I would sit there and look at you and say, okay, let's look at the financials. Well, quarter to quarter. This is the last quarter we have of data, $82.89 billion. The same quarter before, $70 billion, right before the all-time high. So the revenue is up 15%, more than that, 17% year over year, yet the stock is down 40%. What does that prove? It proves our fourth tenet of principle-driven investing. In the short run, stocks are a voting machine. In the long run, they are a weighing machine. The company is making 15%, 18% more revenue than it did comparably when it was at all-time high. We see this all the time. Go look at Tesla. Big example of Tesla. Tesla stock is essentially flat for the last 5 years, even though the business has basically tripled. Why? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. So let's look at some metrics on Microsoft. So the first thing is, I don't care about the stock price. That is not the price of the company. The price of the company is the market cap. This is all the shares multiplied by the number of shares they have outstanding. 2.76 trillion. The next thing I do is I go to that enterprise value, 2.96 trillion. I look at the difference there. Usually enterprise value is above market cap. That means there's more debt than cash on hand, which is okay. And that debt level is $200 billion. But guess what, guys? They made $73 billion in free cash flow last year. $73 billion. They can pay off all those debts that they're talking about there, the difference, in less than 3 years of free cash flow. That's pretty solid. Now, their cash flow is down a lot because they're spending a lot of money on these AI data centers, all this AI. It's a big booming market for a lot of these high tech companies. But we're sitting here. We usually look only at free cash flow, but because we know they're spending a lot, look at this net income. They made $125 billion in net income last year. $125 billion. They made $90 billion a year for the last 5 years. That's a PE of 22. That's after falling 40%, which means this was close to 40, actually even higher maybe a year ago. It was actually higher than that a year ago. That's incredible. In fact, I think we can look at it. Let's pull up the PE here. Look at this PE. Yeah, it was 36 last year. It's looking at let's look at quarterly. Wowza. Yeah. It never got quite to 40 for the average for the quarter, but it was pretty close to there. That's pretty incredible. And look at this. It was well above 40s in 2017. I think that's when they wrote off a big investment they'd made. So that's probably why it dropped so low. So why it went up so high. Guys, a couple of things I love about this company. Look at the profit margin. 10-year average is 33.9%. 5-year average is 36.7%. 1 year is 39.34%. Do you see what's happening here? Their profit margin keeps getting better and better and better. As they generate more revenue, their profit is going up as a percentage of that revenue. That's incredible. That is an awesome metric. And we have great returns on capital. Almost 22% a year for the last 5 years. Drop in the last year because free cash flow is down. All right, let's look at our 8 pillars here. Guys, we have all check marks. Remember I said about debt? Right there. Return on capital is high. They're buying back a little bit of shares. Cash flow is up in the last 5 years. Net income's up over the last 5 years. Revenue's up over the last 5 years. Debt is reasonable. It's just these valuation metrics. But the good news about that is, one, Microsoft's a premium business in my opinion. So I'm not valuing Microsoft the way I'd value the rest of the market. I'm giving it a premium. I'm giving it a higher multiple of earnings. If something is better, you got to pay more for it. That's the fact of life in everything. Microsoft's a better business than some shit company in the S&P 500. I think we can all agree on that. So it deserves a premium. The question is, how much of a premium is it worth? Okay, now let's go to analyst estimates here. Look at this. They have profit at $17 a share here, growing to $40 a share over the next 7 years. That is 2.5x over 7 years. 12 or 13% earnings per share growth. And look at the revenue. Growing from 335 to 760 billion. Again, 2.5x over the next 7 years. That's incredible. Now, remember, these are analyst estimates. We don't know if they're actually going to happen. But if they do happen, that's a lot of potential money for the company and for investors if you pay the right price. Because it's a great story. Microsoft's a great company. But if you pay the wrong price, even for a perfect story, you're going to end up with a bad investment. So what we're here to do is put all this together quickly in our stock analyzer tool. Figure out, make assumptions about the future. And it'll tell us, based on those assumptions, what the right price to pay for it's today. So first off, I did a 10-year analysis, and I can do up to 20 years in the software. Revenue growth, I did 7, 10, and 13%. Profit margin and free cash flow, I put them the same, even though they're not the same right now. I did 34, 37, and 40. Now, keep in mind, guys, they did 39% last year. So if this keeps going up and up, this could be conservative still. Next, what PE and price to free cash flow would I assign to this company 10 years from now? Well, I put 20, 23, and 26. And finally, my 9% desired return. Now, before you get excited about 9%, I don't really want to buy it for a 9% return. That's kind of what's the market return? What would I have to pay today to get that market return? The intrinsic value of the business. I, of course, want a higher return. And I think you should too, because if you just want a market return, buy the S&P 500. Buy the Russell 3000. Sit there and buy those ETFs and don't deal with the hassles. But for this purpose here, we're just trying to find what is it worth to us. I hit the analyze button. I scroll down. Guys, this is why it's interesting. My low price is 360. It was below that just yesterday. High price, 822, middle price of 547. If all of my assumptions occur in the middle, it's a 14.1% discounted cash flow return for the next 10 years. That's a lot. If that's enough for you, I think you should do more work. Because remember, I'm never here to give any stock tips. I'm here to teach a process. If you don't want to learn how to fish, we're not the channel for you. But I will tell you, learning how to fish is great because, guys, if we have a bear market anytime soon, this company could be even lower in price and even be a bigger deal. And people will be like, yeah, but it's at $200 a share. It used to be at $370. It's not. If you follow the stock price, yes. If the fundamentals keep getting better, this could be a major, major, major investment as the price falls. So what's another company here? Because another company I want to look at is something that we talk about a lot, Adobe. Now, these are two companies that Michael Burry has investments in. Like I said, he did some calls on Microsoft and he owns Adobe. He says it's a glaring value play. Now, I want to remember, everybody's like, oh, AI is going to eliminate the need for Adobe. Anthropic and ChatGPT and OpenAI have deals with Adobe to integrate them into the software. Those deals are there. If you go, sometimes I go in there and I ask him to make an image and he'll say to me, hey, go to Firefly. Go to Adobe and Firefly and use that. So I want to remember, even these companies right now are saying this. Now, the other thing I want to show you guys is a cute little chart. Why? Because the stock is down from its all-time high of 700. And its low, this 52-week low, was just last week at 190. That's incredible. But look at this. Let's go look at its revenue. Let me ask you a question. I don't know. Of course, the past doesn't tell us what's going to happen in the future. I don't know if this is going like this or like this or like this or whatever it is. But I'm looking at it going, you know what? Artificial intelligence really became big right here. It still kept going. Does that mean it's for sure not going to keep going? No, it doesn't mean that. But I think this is a major mispricing of the stock. How mispriced? Guys, it's selling for 7.8 times free cash flow. Remember what Microsoft was? Microsoft was 4 times that. It's selling for 11 times earnings. Microsoft's at 22. Their gross margin's 89%, which means every extra dollar they bring in of revenue, 89 cents of it goes to profit before overhead and taxes. Microsoft is 68%. Now, Microsoft has a higher profit margin, and it's growing. Adobe's is the same, 28%, give or take, over the last 10 years. Okay, but I'm looking at going, is Adobe really going to go away forever? It might. BlackBerry did. But I always say to people, there's far more great companies in the world that keep on growing than the BlackBerry flukes that happen. And that was very early in the cell phone game. So that's my opinion. Of course, you don't have to agree with me. I see the message. I see comments sometimes people are like, Paul, you don't get an Adobe. Maybe I don't. That very well could happen. But if you apply the same kind of thought process to other companies, to 30 or 40 companies as you do to this, you might be surprised what happens. So some other metrics. Great returns on capital. 26% a year for the last 5 years, 36% last year. Their free cash flow is getting better. Their free cash flow is bigger than their net income. Larger than their net income. Incredible to me. Price to sales ratio, 3.2. Microsoft was at 8.6. That's just basically the market cap divided by the amount of sales. How much are you paying for every dollar of revenue? You're only paying $3.20 at Adobe. You're paying $8.60 for every dollar of revenue at Microsoft. Great growth rate, 17% a year for the last 10, 11.9 for the last 5, 11% for the last 3. Not many acquisitions, $2.8 billion. Guys, can you guess what the 8 pillars look like? All 8 check marks. And by the way, I want to make note, our community members have intrinsic value here of 412. That's our community members, and it's followed by a lot of people. Let's go see what analysts think in their ultimate negativity. $24 per share, going to $45 a share in the next 7 years. Not quite double, but pretty solid. And revenue for this dying business, $26.5 billion, growing to $46 billion. So all these analysts over the last few years, I saw AI really taking over, and they talked to the company. They still feel confident. Now remember, they're biased just like you and I, so I don't know what's going to end up happening. But I'm looking at all these things thinking, is this a value trap? Am I just wrong on this one? Or is there potential here for this company? So what do? I go to Stock Analyzer tool. Here are my assumptions for the future. And guys, remember, I'm making conservative assumptions here just to be funny. First, revenue growth. I did 3, 6, and 9%. They did 13% year over year very recently, 11%. So I'm going 3, 6, and 9. Profit margin, I'm focusing on free cash flow, 37, 40, and 43. PE. Guys, I think this is low. I did 18, 21, and 24, and finally my 9% return. Now, before I go any further, I want everybody to remember, most people make mistakes in investing because they're too afraid and they sit there and freeze when the opportunity arises for them. Yes, there are companies out there when the stock falls, it is hard to get through the news and realize, oh my God, because the news follows the stock price. And when the stock is falling, all the news that justifies that fall are going to come out. This is exactly why I created our software and our community. Because I realize that there's got to be a better place for people to be able to have conversations in which they can speak the same language. We have software here to validate some of the ideas we have, to sit there and say, listen, I have this idea about this company in the future. How do I know what that's worth? There you go, our stock analyzer tool. The software was created because I made it for myself, and then people said, how do I get that software? So we made it out there. It helps me sleep better at night knowing that I'm looking at this going, let me be more conservative here. Guys, if you're out there, put 2, 4, and 6% in here. If you think it's a declining business, put negative, even, and then a positive number. That's the abilities that you get by having our software. And more importantly, you have the people around you. There's the old adage that you're going to end up like the 5 closest people around you. Don't you want to be around people who are calm during red days? Our group isn't calm. They're excited during bear markets. They look at it as opportunity. That's where I want you to be. So the question I have is, what's that worth to you? What's the community, the software, the peace of mind worth to you to be able to do that in investing? If it's more than $1 a day, I don't blame you. But guess what? We have a 7-day trial for $7. If it's worth $1 a day to try that, to give yourself that peace of mind potentially, isn't it worth it? Click the link below, go to everythingmoney.com, sign up for the 7-day trial, and you're going to see why over 70% of people who sign up for it end up signing up for the year and beyond. It's for the exact reason it changes lives. So on Adobe, I hit the analyze button. The stock's currently at 201. Wow. I have a low price of 280 to 395, high price of 660 to 890, middle price of 430 to 595. Very high potential returns. And guys, like I said, I think I was being conservative above on a lot of things. So guys, this is why it's a great place to look in our software. And by the way, if you sign up for our community and software, you get that list of stocks at or near 52-week lows. It's just a great place to start looking for value. Thank you for your time.